Imagine this. You've got $1,000 in your hand right now. If you had to put it to work in 2025, where would you bet for the biggest payoff? Where would you put it? Crypto, stocks, or real estate? It's a question I get all the time, and the answer isn't as simple as picking one and hoping for the best. The financial world is full of opportunities and risks. Headlines about crypto millionaires and stock market crashes can make it overwhelming for beginners. My goal is to cut through the noise and give you a clear, practical guide to help you make a smart choice with your first $1,000. We'll break down what each investment type really means for someone starting out without jargon or complicated charts. This isn't about getting rich overnight, it's about building a solid foundation for your financial future. Let's dive into the pros, cons, and what you need to know about crypto, stocks, and real estate. Alright, let's dive into the world of alternative investments. First up, cryptocurrency. You've undoubtedly heard of the big names like Bitcoin, the original cryptocurrency, and Ethereum, which brought smart contracts to the table. Maybe you've even stumbled upon the meme-inspired Dogecoin, which captured the internet's attention. Crypto is essentially digital money, existing purely in the digital realm. It's decentralized, meaning no single entity controls it, and it's powered by blockchain technology, a distributed and transparent ledger system. The big draw for many investors, the massive potential returns that crypto can offer. Stories of early Bitcoin buyers turning into millionaires seemingly overnight are everywhere, fueling the hype and attracting new investors. But remember, with huge upside comes huge risk. It's a double-edged sword. Crypto prices can swing wildly. We're talking roller coaster levels of volatility. You might see your investment up 50% one week, feeling like a genius, only to watch it plummet down 70% the next, leaving you wondering what happened. Unlike traditional stocks, there's often no underlying company or assets backing most coins. Value is largely driven by hype, social sentiment, speculation, pure and simple, and sometimes all it takes is a single tweet from an influential figure to send prices soaring or crashing. Therefore, investing your entire $1,000 in crypto without understanding the risks is more akin to gambling than making a sound investment. You could hit it big and see substantial returns, or you could lose it all in the blink of an eye. Scams are rampant in the crypto world, hacks of exchanges and wallets are frequent occurrences, and unfortunately, failed projects and dead coins are far too common. The crypto space is still largely unregulated, which means there's less protection for investors compared to traditional financial markets. For beginners venturing into this space, a smarter and more cautious move is to allocate only a small amount, maybe $50 or $100 to start with. Use this small amount to dip your toes into the crypto waters. This allows you to learn and experience the market firsthand, understand how it fluctuates, and get a feel for trading, all without risking your entire investment. Some analysts predict another bull run in 2025, anticipating significant price increases across the board, but it's crucial to remember that nobody can guarantee it. Market predictions are just that, predictions. Increased regulation or a major hack of a prominent exchange could easily send prices crashing down, wiping out gains in an instant. Crypto is generally best suited for those with a high risk tolerance, who are comfortable with the possibility of substantial losses. It should also be considered only after you have other, safer investments already in place, forming a well-diversified portfolio. If you're genuinely curious about exploring the world of crypto, start small and manageable. Do your own thorough research on any project you're considering, and most importantly, never invest money you can't afford to lose. This is a golden rule of investing, especially in volatile markets like crypto. Read up on the specific projects you're interested in, understand the underlying technology, and carefully assess the potential risks involved. And absolutely don't buy into a cryptocurrency just because of hype or fear of missing out, FOMO. In summary, crypto offers explosive potential for growth and high returns, but the risk of losing a significant portion or even all of your investment is very real and should not be taken lightly. It's often described as the Wild West of finance, uncharted territory with both incredible opportunities and significant dangers. It's exciting but potentially dangerous, especially for beginners who are just starting their investment journey. If you want to dip your toe in and explore this new frontier, keep your exposure small, manageable, and treat it primarily as a learning experience to gain knowledge and understanding. For most first-time investors and even seasoned ones, crypto should ideally be a minor part of your overall investment portfolio, not the dominant or only holding. The key takeaway here: only invest what you're truly willing to lose without impacting your financial stability or well-being. Now, with that cautionary note in mind, let's shift gears and move on to a more traditional investment option: stocks. Next, let's delve into the world of the stock market, the classic and time-tested way to invest your money. It's a cornerstone of wealth creation for many, and understanding its basics is crucial for any aspiring investor. We'll explore what it means to own a piece of a company and how that ownership can translate into financial growth. When you buy a stock, you're not just purchasing a ticker symbol. You own a piece of a real company, a tangible entity with employees, products, and a vision, like Apple. You become a shareholder entitled to a portion of the company's profits and assets. Or Google, another tech giant that has shaped our modern world. Owning stock in these companies means you participate in their success. If the company grows, expands its market share, and increases its profitability, your investment grows in value alongside it. This is the fundamental principle of stock investing. Some companies even pay dividends, regular cash payments, often quarterly, distributed directly to shareholders as a reward for their investment and a share of the company's earnings. The stock market isn't a new phenomenon. It has a long and storied track record dating back centuries. It has weathered numerous economic cycles, wars, and technological revolutions. Over the past century, despite periods of volatility and downturns, the S&P 500, a broad index representing 500 of the largest publicly traded companies in the US, has averaged about a 10% annual return. This highlights the power of long-term investing in the stock market. The key to unlocking the stock market's potential is long-term investing. It's about adopting a patient and disciplined approach, focusing on the long-term growth of your investments rather than trying to time the market. Markets go up and down, volatility is an inherent part of the stock market. Stock prices fluctuate daily, influenced by a myriad of factors, from economic news to company-specific announcements. But staying invested over years, even decades, is what builds wealth through the magic of compounding. Reinvesting dividends and allowing your investments to grow over time can lead to substantial returns. Today, apps like Robinhood have democratized access to the stock market, making it easier than ever for anyone to start investing. And established brokerage firms like Fidelity offer user-friendly platforms and a wealth of educational resources. These platforms let you start with just a few dollars, even buying fractional shares of expensive stocks like Amazon or Tesla, making it accessible to investors with limited capital. Diversification is crucial for managing risk in the stock market. Instead of betting on one company, which can be risky, spread your money across many different companies and sectors. This helps to mitigate the impact of any single company's poor performance on your overall portfolio. The easiest way to achieve instant diversification: ETFs, exchange-traded funds, funds that hold a basket of hundreds or even thousands of stocks. An S&P 500 ETF, for example, gives you instant diversification across the 500 largest publicly traded companies in the United States, and significantly reduces the risk of any single company failing and wiping out your investment. Of course, stocks aren't entirely risk-free. Markets can crash, as we've seen throughout history, and individual companies, even large ones, can go bankrupt. But a diversified ETF is a much safer and more prudent approach than picking one individual stock or investing in a volatile asset like a single cryptocurrency. Compared to crypto, which can experience wild price swings, stocks, particularly those held within diversified ETFs, offer steadier, more predictable growth over the long term. While you probably won't turn $1,000 into $100,000 overnight with stocks, as some might promise with riskier investments, you're also far less likely to lose your entire investment in a sudden market downturn. Capital preservation is a key benefit. Looking ahead to 2025, stock market performance will undoubtedly be influenced by macroeconomic factors such as inflation, interest rates set by the Federal Reserve, and the overall health of the global economy. But the core principle of investing in broad market ETFs remains the same. It's a bet on the long-term economic growth and prosperity of the world's leading companies. Think of investing in stocks, especially through diversified ETFs, like planting a tree. It takes time, patience, and consistent nurturing, but the rewards compound over the years, providing shade and sustenance for generations to come. For most beginners who are just starting their investment journey, putting your initial $1,000 into a low-cost, broadly diversified ETF is generally the smartest and most responsible move. You gain immediate exposure to a wide range of industries and companies, representing the entire economy. Minimize your risk by spreading it across many different assets, and set yourself up for steady, long-term growth. The risk associated with this approach is moderate, higher than simply keeping your money in a savings account, which often doesn't even keep pace with inflation, but significantly lower than venturing into the highly speculative world of crypto. The chance of a broad-based ETF, like an S&P 500 ETF, going to zero is almost non-existent, given the diversification it provides. In summary, stocks, particularly when accessed through diversified ETFs, offer a balanced approach to investing. Solid potential for growth, a moderate level of risk that is manageable, and easy diversification to protect your capital. It's a proven and reliable way to build wealth over time, making it an especially suitable option for first-time investors who are looking to start their financial journey on a solid foundation. Now, with a good understanding of stocks under our belts, let's shift our focus and talk about another popular investment avenue: real estate. Real estate has long been considered a cornerstone of wealth building, a tangible asset that can provide both income and long-term appreciation. It's a classic strategy for those looking to secure their financial future. However, the traditional image of real estate investing often involves significant capital. Buying property outright with just $1,000 isn't realistic in most markets. The upfront costs, including down payments, closing costs, and potential renovations, can be prohibitive for many aspiring investors. Luckily, the world of finance has evolved, offering accessible alternatives. You can invest in real estate through REITs, real estate investment trusts. These innovative financial instruments have democratized real estate investing, making it possible for individuals with limited capital to participate in the market. REITs are companies that own and often operate income-producing properties. They act as landlords on a large scale, managing diverse portfolios of real estate assets. This includes apartments, providing housing for individuals and families, malls, the centers of retail activity and consumer spending, and warehouses, the backbone of modern supply chains and e-commerce. When you buy a REIT, you're not just investing in a single property. You own a slice of a big, diversified real estate portfolio. This diversification is a key advantage, as it reduces your exposure to the risks associated with any one particular property or market. REITs trade on the stock market, just like publicly traded companies, so you can buy in with just a few dollars, just like stocks, making it an accessible entry point for new investors. This ease of access is a significant departure from traditional real estate investing. The big perk? REITs are legally required to pay out most of their profits as dividends, giving you steady income in addition to any potential appreciation in the REIT's share price. This consistent income stream can be a valuable component of a well-rounded investment strategy. For even greater diversification, you can invest in a REIT ETF or exchange-traded fund. This approach spreads your money across hundreds or even thousands of properties for instant diversification, mitigating risk and providing exposure to a wide range of real estate sectors. REITs are generally less volatile than stocks, meaning their price fluctuations tend to be less dramatic, and much less than crypto, which is known for its extreme price swings. However, it's crucial to remember that they're not risk-free. All investments carry some level of risk, and REITs are no exception. Real estate markets can crash, as history has shown, leading to significant losses for investors. Additionally, some sectors, like offices, which are facing challenges due to remote work, or malls, which are struggling with the rise of e-commerce, can struggle, impacting the performance of REITs focused on those areas. Crowdfunding platforms like Fundrise offer another avenue for real estate investment, letting you invest directly in specific real estate projects, often with lower minimum investment amounts than traditional property purchases. However, a key consideration with crowdfunding platforms is that your money is often locked up for years, making it difficult to access your funds if you need them unexpectedly. This lack of liquidity can be a significant drawback for some investors. For beginners, publicly traded REITs or REIT ETFs offer a good balance of accessibility and diversification. They are the best way to get real estate exposure with flexibility, allowing you to buy and sell shares easily and low cost, as transaction fees are typically minimal. Real estate, particularly through REITs, can help balance your portfolio by providing a hedge against inflation and diversifying your holdings beyond stocks and bonds. Sometimes when stocks fall, real estate holds steady or even rises, providing a cushion during market downturns. This inverse correlation can be a valuable asset in a volatile economic environment. Historically, REITs have delivered strong returns, often outperforming other asset classes over the long term. This is especially true when you factor in dividends, which can significantly boost your overall investment returns. For 2025, real estate's outlook depends heavily on interest rates, as higher rates can increase borrowing costs and dampen property values. It also depends on demand for rentals, which is influenced by factors like population growth and affordability, but diversification within the real estate sector helps manage risk. Compared to crypto and stocks, crypto is high risk, high reward, offering the potential for rapid gains but also carrying a significant risk of substantial losses. Stocks offer steady growth, providing a more moderate risk-reward profile and a track record of long-term appreciation. Real estate, through REITs, gives you a compelling combination of income, growth potential, and valuable diversification, making it a worthy addition to any investment portfolio. If you value stability in your investments and want to diversify your portfolio beyond traditional assets, putting part of your $1,000 into a REIT ETF is a smart move, allowing you to participate in the real estate market without the complexities of direct property ownership. Real estate is no longer just for the wealthy and institutional investors. It's been democratized and anyone can get started with a small amount, thanks to the accessibility of REITs and REIT ETFs. In summary, REITs offer a unique mix of income and growth, with moderate risk and valuable diversification, making them a compelling option for investors of all levels. Now let's wrap up with how to make your choice and determine if REITs are the right fit for your investment goals and risk tolerance. So where should you invest your $1,000 in 2025? There's no one-size-fits-all answer. Crypto offers big upside but huge risk. Stocks, especially ETFs, provide steady growth. Real estate, through REITs, adds income and diversification. The right choice depends on your goals, timeline, and risk tolerance. You might split your money, say $700 in a stock ETF, $200 in a REIT ETF, and $100 in crypto to learn the ropes. The most important step is to start. Don't let fear or indecision hold you back. Investing is a marathon, not a sprint. Consistency and patience are your best friends. Thanks for watching. Let me know in the comments where you'd put your $1,000, and don't forget to subscribe for more investing tips.